What if I told you that a single group of people just made a decision that could affect your mortgage rate, the job market, and even your credit card bill? Stick around because in the next 5 minutes, you'll see why the Fed's decision today might impact more than you think. The Federal Reserve, 3 words that can send Wall Street into a frenzy. But who or what is the Fed really? The Fed is responsible for a dual mandate. They want to keep unemployment at a healthy level, and they also want to keep prices stable. Now, they have some tools to do this. They can tweak short-term interest rates and buy or sell bonds in the open market, known as quantitative easing or quantitative tightening, also QE or QT. They're trapped in a tug of war between controlling inflation and having healthy growth in the economy and the job market. Therefore, every move is like a high-stakes balancing act. All right, now that we see the battlefield, let's unpack the Fed's most powerful weapons. So what is QE and QT? Imagine the economy is a bathtub. When the water level is too low, you turn on the faucet and you add more water. That's QE. The Fed buys bonds, flooding banks with cash. Loans get cheaper, businesses expand, people spend, the tub fills up, but water can overflow. Now, imagine the tub is overflowing. Water's running everywhere, you turn off the faucet, you try to drain the tub. That's QT. The Fed sells bonds, pulling money out of the system. Borrowing costs rise, growth cools, the water level drops, and the mess subsides. Great, so now we know how they add or how they remove cash. But what about that little number that everyone watches, the interest rate? So how do interest rates affect everything? When rates go up, stocks typically drop. When the Fed increases the federal funds rate, banks have to pay more to borrow money overnight. On the surface, it's really just a number, but this cascades. Mortgages become pricier, credit card rates climb, and businesses rethink their expansion plans. Stock valuations also fall because future profits are discounted at a heavier rate. Craving a new car? You might wait. Dreaming of that new startup? That may be on hold, which is exactly what the Fed wants when they're trying to tackle inflation. Okay, so we've seen the tools and the number. Let's check the scoreboard. How's the economy actually doing right now? Here's where we stand. Q1 GDP fell 0.3%, marking the first negative reading in 3 years. Although this number was affected by swings in net exports, which is ultimately affected by the tariff impact. Employment stayed strong. April added 177,000 jobs, and unemployment is at a healthy level, just 4.2%. Inflation, though, still sits above the Fed's target, sitting at 2.4% versus the Fed's target of 2%. So the economy is strong, but inflation is still sticking around, putting the Fed at a crossroads. So let's find out which road they decided to take today. Today's decision, the Fed held interest rates to 4.5% and continuing QT or quantitative tightening. Why? Because inflation's stubborn and current tariff policy may threaten the progress that they've made in inflation so far. And ultimately because there's really just so much uncertainty right now that the Fed doesn't even know what to do. So all we can do is try to stay informed and stay up to date on what could move the market. Now, if you found this breakdown useful, hit that like button and subscribe for our next upcoming video breaking down Google's big drop today. And as always, leave a comment below or drop any questions.